Recyclico, making lithium-ion last forever. Recyclico's patented recycling process achieves up to 100% recovery of battery metals from lithium-ion batteries for electric vehicles, including cobalt, lithium, nickel, manganese, and aluminum. Recyclico Battery Materials Incorporated trades on the TSX Venture AMY, on the OTCQB AMYZF, and Frankfurt ID4. For more information, visit recyclicode.com or phone us at 778-574-4444. Recyclico, making lithium-ion last forever.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Counsel Incorporated. Her websites jugglingdynamite.com and venablepark.com. Welcome back to the show, Danielle.
Hey, thank you, Jim.
Danielle, how soon before the central banks start cutting their trend-setting rates?
Well, this is the trillion-dollar question right now. Everyone's very focused on it, and I think they are putting too much emphasis on that question because what we've seen in past cycles is that when they start cutting, it's actually a sign of economic weakness, and that is when the unemployment rate really starts to spike, and that is when the worst of the losses happen for financial markets. So, there's been at the last, say, couple of months of 2023, there was a lot of talk about the fact that central banks were conceding they'd probably hiked for the last time and that they were now in that pregnant pause before they were inevitably going to start cutting. And there was all this sort of happiness in markets anticipating that the rate cut cycle was about to start and that we'd got through the fastest, most abrupt tightening cycle in decades without a recession, right? So they were all like, oh, great, look, we've had a soft landing, there's no recession, all systems go. Actually, I don't think that was the take from the data whatsoever. Everyone has to be mindful of the lags between the rate tightening and the impact on the broader economy. And in fact, we've seen that both with households and with corporate debt because a lot of people locked in rates back in the 2021 period when rates were at 5,000-year lows. But those are essentially terms, of course. It's only in the U.S. that people get to lock in rates for 30-year mortgages and that sort of thing. In Canada, we have, as 1, 2, 3, 4, 5-year terms, and the same goes with corporate debt. It's not perpetual. It's always a fixed term. And so as we enter 24, we have, about a third of Canadian mortgages coming up for renewal just in 2024, and the average increase in rate is going to be significant at a time when they're already struggling to make ends meet and paying, 50% of their household income towards shelter costs. The same for corporate debt. In 2023, in U.S. corporate debt was 7% of its profits, which is the payments they made were 7% of their profits, which is historically about as low as it's ever been. And again, that's a function of this having locked in rates at the very lowest in the 2021 period. But again, as we move into 24, we're seeing a lot of defaults on debt payments, delinquencies, companies and people, households falling behind on payments. And then as they're coming towards their renewal dates, it's getting harder for people to find replacement financing. And so that is this next sort of wave of the credit cycle when, we've seen a contraction in bank credit. That's only ever happened, one other time in the last 50 years, and that was in the 2008 cycle, briefly in 2020, but it was sort of bailed out very quickly by all the fiscal support from governments. But the bank credit cycle is contracting. We're seeing a lot of those private debt funds that were so popular in the zero interest rate environment when people were desperately seeking places to make above market rates, and they were piling into these very illiquid, opaque products, which were essentially, private debt, private equity funds that were wrapped and sold to retail people as a replacement for some of these more traditional forms of investment. And what happened was it looked great for a while, but then as this year has unfolded, a lot of them have now frozen the ability of people to take money out because they don't have liquidity and they don't have enough cash available to meet the redemption demands. So we're getting a shock to the system because, a lot of these funds depended upon this notion that the high-risk entities they were providing funds to would then have ultimately refinance into more traditional bank credit and give back the principal plus the interest. And in many cases, they weren't even collecting the interest as they went. It was a compound to maturity kind of thing, sort of like what the banks have done in the last year with those who couldn't make, with variable rate mortgages that, allowed people to make flat payments and not all the interest payments, and they just kept sticking it on the principal outstanding. Well, that's happened in the corporate space, in the private equity, private debt space. And so you've got all these debts now compounding, and the exit event, the ability to get money in a balloon at the end to pay back all the people who are expecting to get their money back and to get liquidity is a shrinking pool. So it is it's like the exit has dropped down to, a tiny little point, and you've got this herd of people trying to get out that exit. So as that stress hits the overall markets, we're seeing all kinds of, things fall apart or disappoint or shock the people who are depending on them. And so that's, I think, going to continue in 24. As I say, a lot of this stuff is just starting to refinance at these higher rates. And that's going to be a theme in 24. And also, as I say, the unemployment rate is now the bogey that everyone's fixated on.
Now, what is the state of Canadian real estate right now? Are people selling at a loss and still owe money even after they've sold?
Well, of course, it depends when they bought, right? Yeah. So, yes, there is there's a rising amount of listings. A lot of people are holding off till the spring if they're able to, on this presumption that things will pick up in the spring. I'm not so sure that's going to be the case because there's an awful lot of inventory of people who are thinking they can get prices from 2 years ago. And then there was an unfortunate amount of people who bought right at the peak of the cycle in 21, 22, when rates were, when mortgage rates were under 2%. And they bought too much property, and now they're finding a hard time covering the costs, and they're looking to offload that. Now, in many cases, the financing was, taken from a primary residence, the down payment for the secondary or the rental or the investment property. And so they've got this daisy chain now of debts all over that they're trying to consolidate. But as I say, it's harder to qualify for credit, so it's harder to get these loans sufficient to pay off existing balances. And also, we saw this in a lot of the pre-sales that happened during the low-rate environment where these properties are now just coming to fruition or being completed, and people are not able to get the financing because there was an example that I put on the blog this week of near the Ottawa area where there was 40 townhomes that had been sold at peak pricing, just under $1 million in the 900 range. And as they're coming to completion, of course, not only can people not qualify for mortgages to purchase these things at current rates, but the other part of it is that the appraisals are coming in at a significant discount, like $500K as a market value, not $900,000. And so they can't even get anything close to that kind of money to close. And so builders are either having to decide to, keep deposits and try and sue people, or let them walk, which they're doing in some cases in the hopes that they can turn around and sell them at, lower, but to people who can actually get financing to buy these at current rates and current prices. So that's all happening, and at the same time, the amount of companies and lenders that are proceeding on foreclosures is rapidly rising. And I was talking about this before because of my, connections to both trustees in bankruptcy, but also to the legal community. And I'm closely tracking the amount of power sale foreclosures that are coming through the legal system, they've really picked up in the last couple of months, and we're not seeing any abatement of that in 2024. So you are getting a lot of people getting sued now for balances that they've fallen behind on, and lenders are seizing properties. That's always something they do reticently because they don't want to typically be property owners. They just want to collect interest and get their money back at the end. But when the debtor, of course, defaults, they often have no choice but to go and get the property. And then ultimately they want to get rid of that, so that increases selling pressure in the marketplace, and that pushes down prices, and it's sort of this cascade of woe for those people that are trying to collect, outsized debts against falling asset prices. So that's certainly happening now as well. And I think, again, we're only just started. Like, this all clear signal is way too premature because we see the wall of these mortgages that are coming up for renewal over the next couple of years. And, even if we get rate cuts, So here's the thing, we have rates normalized now, benchmark rates for the Bank of Canada around 5%, in the U.S. just about 5.5%. That's really where they were at the peak of the 2008 tightening cycle too, just before that recession started. That was kind of where rates peaked out. But the bond market has been rallying. The Treasury market has been rallying now since October. And that, in effect, has lowered already the mortgage rates from peak, because when the Treasury bond prices rally, their yield falls, and they ultimately impact the mortgage rates that are being charged on fixed mortgage terms. So the mortgage rates have already come off from the peak, but again, relative to where they were at the all-time low, where much of this debt was taken out, it is not any great relief to say, well, hey, your mortgage rate's only going to be 5, not 6. When it was 1.5 or 1.75, this is still abhorrent for the person to be able to keep making the payments. And then, as I predicted, the municipalities are really starting to increase the property tax rates that we're seeing across the country. And I said that a couple of years ago, and the reason I said that was the too many governments had become so dependent on these real estate transactions, the huge volume of real estate transactions and property transfers. So provinces get, of course, land transfer tax off transactions in the property market. Municipalities charge, as you know, property taxes. And I was just looking at the dynamics of that and going, when this turns down, their revenue is going to collapse at a time when they still have all these commitments in terms of programs and basic services that are required. So the spending doesn't contract, but the revenue does, and they became unduly concentrated in dependence on the real estate sector. So sure enough, that's happening, and budget deficits are ballooning out. And we saw places like the City of Toronto shock owners this week with an announcement that they're going to have to increase property taxes by 10.5%. They're trying to negotiate an infusion of capital from the federal government, and if they can't do that, then they're looking at having to increase taxes by as much as 16%. So, all of these things compounding, and this is all over, like in America as well, and in Canada, when properties didn't transact for a considerable period of time, the base rate that the tax system used was, quite a backward-looking market value to assess against the mill rate and come up with the taxes. Once you get these transactions that happened, as I say it, when property prices basically doubled in a matter of 5 years or less in Canada in many areas. Now the mill rate is backward looking at those prices where they last transacted. And so the tax portion that's being implemented is much higher. So people are facing escalating costs in that regard, on top of the interest costs that have gone up so much, on top of things like insurance. Unfortunately, that's another major problem because, there's been all this catastrophic weather, but there's also been a rash of people, random burnings of properties. I was speaking to a developer last weekend, and he said in his a couple of his subdivisions in Toronto, we'd already had 5 houses burned to the ground by people who were trying to get out of the contracts. Well, ultimately, this all affects the premiums. We've also got an epidemic of car theft. We've also got an epidemic of theft from stores. So all of this insurance has to be paid somehow, and so we're getting premium increases across the board, both on vehicles and homes. So it's really a terrible mix, and sadly a lot of people are very unprepared for this, and as I say, we're just getting into the uptick in unemployment, which is going to be the final straw, that breaks the back of this thing when people's income is depreciating, and we're already seeing that in the average hourly work week, which has declined. And a bunch more layoffs from small to large corporations, again, year to date. So all of that together tells me that we haven't seen the hardest of this landing yet, and that we're moving into that in 24.
We'll have more with Danielle Park right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Danielle Park. A lot of excitement in the U.S. with Bitcoin getting an ETF approved, but we've had a cryptocurrency ETF in Canada, in fact, several in Canada. What was the story there, and is this exuberance in the U.S. overblown?
Well, back to what I was talking about earlier in this predilection of the finance sector to take these very high-risk, nebulous concepts and put them inside retail wrappers to try and make them more accessible so they can sell them to the public, right? So this is what's happened with Bitcoin. It's this not just Bitcoin, but all of this crypto space. It's been rampant with fraud. Not just the FTX collapse and Sam Bankman-Fried going away, but there's just enormous volatility, high capital risk, lots of sketchy players. So all of that is already an area rife with risk for individuals, especially those who are thinking they're doing something as an investment, quote unquote. Because again, if you're gambling or going to a casino, most people know, okay, I'm going to take X dollars and I can afford to lose that. And then when I lose that, then I shouldn't be surprised because I was gambling. Unfortunately, when they make these things into quote unquote investment products, people approach them with a much different allocation mindset. They often take a significant portion of whatever savings they have and start plopping it into these things, and indeed sometimes into different ones in the same sector, thinking that's some kind of significant diversification, when in fact they're all highly correlated one with each other. And again, making them, putting them inside these wrappers and calling them liquid, saying, oh, don't worry, you'll be able to get your money back whenever you want, and you don't have to worry about buying or selling the individual cryptocurrency because we'll look after all that for you. Yeah, fine and well until people want their principal back, right, which is what we're seeing with these private equity pools or private credit pools where people start making redemption requests, and suddenly the ETF or fund goes, oh, we don't have that kind of cash lying around. We have to sell some of this stuff, or we have to borrow against it in order to give cash back. So that just ratchets up the risk profile. And so the ETFs that came out, Purpose had one in Canada, was an early product creator in this space. They came out, sold heavily to the public when crypto was kind of at its nadir there a couple of years ago, and then of course proceeded to crash with the underlying cost price of the cryptocurrencies in 2022. And so people lost heavily on these units. Of course, the fund company is still collecting a fee under the hood, right? So they're in it for they've got these attractive smarties they can sell people, and they're in the business of selling and getting cash in exchange for their product. So they keep doing it, and then they, begin to lobby the regulators and convince them that it's, appropriate that the somehow in the retail crowd's best interest to have access to this as a portfolio diversifier and all that, which is all just sell-speak nonsense for we want to make profit off the uninformed is essentially the story. So that's what happened in Canada, and they lost money until all this frenzy reignited in the last couple of weeks because there became news that the SEC was going to approve this type of product for the U.S. as well. And there's been a lot of, people that have better markets who look for the ethical and look out for the retail person's best interests in this type of thing, along with many other people, including myself, independents not in the business of selling products, who have pointed out that this is going to be a disaster, too much risk, and again, wrapping it in a certain marketing profile doesn't change the guts of the instrument, which is essentially this high-risk, high-volatile, highly illiquid idea that they have inside of it. So it rallied, the crypto space rallied hard this week because they did get that approval. There's a revolving door, unfortunately, between the regulators and the private companies that lobby them for these product approvals. We've seen that time and time again, where they, get certain things passed on the inside and the regulatory side, and then go on to take very lucrative positions in the private companies they helped. So it's not looking out for the best interests of the individuals. It's very much a predatory environment, and that's why I always try and warn people of that, because unfortunately the marketing dollars all go to the side of trying to convince people to buy these things.
They never tell you about the losses.
Well, they don't tell you about the losses, but they also don't. The worst part is, generally speaking, people are not particularly literate when it comes to investment markets, and no wonder. It's a very complex cesspool in many ways of all these competing interests and salesmanship. So it's very hard for an individual on the outside to understand all this plethora of products, or the fact, indeed, that most of them are highly correlated. In fact, when there's a risk expansion or appetite, you see all of these things kind of rally, and then when there's fear or, a credit event or stress or need to raise cash, everything gets sold altogether. So these products are a very questionable benefit in terms of diversification. You really have different colored jelly beans, all of the same kind, So there's that. And invariably, people will say, I wrote this in my book years ago, that, if the risk-free rate is 1%, if that's what you can get on a GIC or a bond, the highest quality credits, if the risk-free market rate is 1%, and someone's offering to give you something with a notional yield of 8 or 10 or 12, alarm bells ought to go off in your head that this is not anything close to, a low-risk product. This is clearly a much riskier bet because they're offering you so much more than can be garnered from traditional or safer instruments. So it really should be an alarm bell that warns most people that this is not likely going to be in their best interest. But unfortunately, most people just don't understand or understand enough to get themselves into trouble, and they're motivated primarily by greed. And that, in fact, is what we're seeing again with the rally that happened between October and December. Things like the investor sentiment gauges were all at the most bullish ever seen in market history again within a couple of months, and the CNN fear greed gauge is back to extreme greed, etc. And that's why we come into 24 and we have, of course, a negative week to start the year, and we're into more losses this week, and people are, going to be surprised because they thought the coast was clear, right? Like apparently they were convinced that the worst was behind us. But that's just a complete misunderstanding of market cycles and the nature of this beast and the lags that are implicit in changes in the monetary cycle. So I think 24 is going to be a year where people get some tough lessons learned.
Danielle, thank you so much for chatting with us.
Thank you.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Council Incorporated. If you have any questions for Danielle or for any of our guests, you can send them to info@housestreet.com. Find us on X @HouseStreet. Our YouTube channel is Talk Digital Network. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.